AI Finance Daily, where artificial intelligence meets your money. Here's something worth your next 5 minutes. The AI safety panic is overblown. Here's what the actual risks are. The existential risk narrative around artificial intelligence has captured imaginations, but it may be distracting us from the more immediate and concrete challenges we face. Let's start with what the doomsayers believe. The argument goes that superintelligent AI could emerge suddenly, acquire unstoppable capabilities, and pose an extinction-level threat to humanity. It's a compelling story. But when we look at the actual data, a different picture emerges. Current AI systems, even the most advanced ones, remain narrow in their capabilities. They excel at specific tasks, but lack the general intelligence that could lead to the kind of runaway scenarios we're warned about. The real risks are more mundane, but no less important. First, there's the concentration of power. As of early 2024, just 3 companies, Microsoft, Google, and OpenAI, control most of the leading AI models. This creates what economists call oligopolistic market conditions. The barriers to entry are enormous. Training a state-of-the-art language model can cost upwards of $100 million according to industry estimates. Then there's the environmental impact. Training a single large language model can generate as much carbon dioxide as 5 cars driven for their entire lifetimes, based on research from the University of Massachusetts Amherst. But perhaps the most pressing risk is economic displacement. McKinsey estimates that by 2030, approximately 375 million workers globally may need to switch occupational categories due to AI-driven automation. This isn't necessarily negative. Previous technological revolutions created more jobs than they destroyed. But the transition period matters. The Industrial Revolution eventually raised living standards dramatically, but it took generations. The real challenge isn't preventing AI apocalypse, it's managing the transition. We need to focus on 3 key areas. First, market concentration. We need regulatory frameworks that promote competition while preserving innovation. The European Union's AI Act provides one template, though it's too early to judge its effectiveness. Second, environmental impact. The industry needs to prioritize efficient computing and renewable energy sources. Some progress is happening. Google's DeepMind, for instance, reduced its AI training energy usage by 70% through better algorithms. The third, workforce adaptation. This requires investment in education and retraining programs. Singapore's Skills Future initiative offers one model, providing citizens with credits for continuous learning throughout their careers. The market seems to understand this. Look at where venture capital is flowing. Not to companies promising AGI breakthroughs, but to those solving practical problems in areas like healthcare, education, and business process automation. The key question for investors isn't whether AI will change the world, it will, but rather which companies are positioning themselves for the actual challenges and opportunities, not the hypothetical ones. Remember, risk isn't what makes headlines. Risk is what we fail to see coming, because we're distracted by more dramatic scenarios. The figures and trends discussed here are drawn from publicly available research and industry reports. Always verify data independently before making any investment decisions. This analysis is meant to inform, not to advise. This has been AI Finance Daily. Stay sharp, and if you want to keep thinking clearly about AI and your finances, follow the channel. We publish regularly, and every episode is built to give you an edge.